market actually did it now, but then it did not actually get into the low, but then it moved, and that was the SMT thing. Now this low, this particular low, if you take this particular low in the Euro USD, market actually came into that low in the Euro USD. Okay, but it did not do it in the GBP. So that was why I knew that okay, yeah, the market, the trend has changed. The fact that Euro USD has reached that point and has corrected itself to a bullish move. GBP USD, although it has not reached that side, I knew okay, it was going up. Now, so that was how I knew market was going up. And you also, you would have been expecting something to happen from here, from this side. So you don't just blindly think that okay, market will just continue on one direction like that. No, there are parameters and there are things you check. There are I think factors you check that determine how far a bullish movement will go, how far a bearish movement will go. And then you see them, check if they check your boxes, and if they check your boxes, okay, you know we're fine. So that's what happened here, and that was why we had that sale, and then market continued bullish without market changed bullish. Now, so let me show you something in the Euro USD. I know the chart is not really as clear. Let's see something in the Euro USD. Okay. Okay. So this was my Euro USD charts. I know we've analyzed this chart. Both of us have analyzed this chart once. This part was where I was looking at market to take. Market took it out, respected it, and then it came back. This was Tuesday, okay, and this was an FVG. Now observe, I marked out this place. I was expecting markets to come below 50%. I always emphasize 50% for you. Now, it doesn't happen always, but most of the times that's what market does. It comes down 50% of the previous range it has created, 50% or lower of the previous range it has created before moving upwards. Now, so this was it, and the market retraced into it. So I was expecting it to touch this guy here. That was why I ruled that line. The market actually came down to that place and then started its bullish movement. So when that happened, so okay, this is when that happened, I knew that okay, this guy has reached this place, but GBP did not really touch that fair value gap. So I knew there was an SMT. The SMT I just explained to you, the tracking correlation. I knew that okay, market has changed direction. As I told the SMC now, I will expect you. What I will expect you to do is write it down, and then later on you go and check up a video on SMC. Yeah,
Okay.
we'll discuss it. But when you check up these videos and then you get prior knowledge, it becomes easier to clarify anything in class. So I was expecting markets to. This was already bearish day, bearish day. So I was expecting market also based on candle science or candle how candle prints, take out this low firstly, and that was the objective. That was what it did. It came, took out the low first before it started a bullish move. If we go down to 1 hour, if you're lost, tell me. If there's something you want me to recap, tell me. If you're following everything I've said, fine.
Yeah, I'm following. I'm following.
Okay. So this was the 1 hour for Euro USD. Okay. So in the 1 hour, this was the area I was looking. This was that place I marked, and I was looking forward to price coming down to that side. And this was the previous day low. So I was expecting, since it was a bullish trend, a bearish trend, market should take out this previous day low. And then it took out the previous day low and then closed bullish. So I knew that when market comes to this side, because that's what it does. If market has taken the liquidity it is coming for, it will change to its direction that it wants to. Remember, it's just like it's like the catapult, something I told you. When you draw it backwards, if it has gone back enough to facilitate the movements that it wants to, you will release it, isn't it?
Yeah.
You draw it as far as you want it to go, and how much you feel the opposing force would take the stone to the direction you want. And when you've gotten to that point, you will release it and then it's allow it to go to the direction you intend it to. So that's what happens. So in a bullish trend, if market comes into an FVG, it is not staying there, it will not rest there. It will move out quickly. It's in a hurry to do something, so it will move out quickly. And that's where you see wicks. So it will come in and then start again. So that was why when it came in, it moved. It did not just sleep there and it did not continue there. Not be in house, but I think get where in the go. You get where in mind dey. So that's what happened here. And that's also what happened in GBP USD. So ultimately the trend was bullish, but we know we would have a bearish day. We saw the sign of a bearish day from the daily time frame already. Daily time frame told us that okay, it is now set for us to have to get the impulse move downwards, and we traded it also, and we were not supposed to hold it till like kingdom come because there was a target, there was a place it was going to. So once it got to that place, it changed back. This is GBP USD, and it got to that place, it changed back to bullish trend. So that's for that.
Okay.
So anytime you're doing your time frame, your analysis, anytime you're doing your analysis from your daily time frame, you would mark out the area you're expecting markets to react in for that week. So that should be your concentration points. When you've marked out that area, those areas should be your concentration points. You're not looking at any other thing the market has done again. Forget those ones. You've already done that. So that should be your area. And when an objective is met, you fall back to the higher time frame again and check what the next probable move is. You mark out the area also the market will be reacting from that day. So that is how you do it. So that is why on Tuesday I wasn't expecting market to come to this side, to this high here. I wasn't expecting it to make one erratic move upwards. No, I knew that it will react inside this place. Sorry. Okay. I know that it will react inside this place. And so that was just my attention. You see how little it is? That was just my attention for the day. So all those big market, no, 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 you're not doing that. It's easy. That's why I said it is easy if you follow it the way I've taught you. So it was just this little box that I was looking at, and my anticipation was, guy, go above this little box, go above 50% of it, and then from 50% come down, and don't go outside the 50 and the box also. So you see how little it is. So when you follow it like this, the areas of concentration becomes limited and your precision gets higher. Your precision becomes higher in the market. So that's for that. I don't know if you still have any questions on that thing. We spent a
Yeah.
lot of
Question number two.
okay.
Assuming you wanted to take that trade new now, where would you have
Yeah.
kept your stop loss, knowing that there is every probability that it will go up? Would you have gotten caught that stop loss if you are the one? I just wanted to know, like, what is the intelligence you would have used so that even if you want to trade this more and get out, you will just be smart enough to know that if you leave the market by here before going up. I don't know whether you understand my question.
Yeah, 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 I get what you're saying.
Mhm.
Now let me tell you, this is what I would do. If I'm to take it from a higher time frame, that's the higher time frame. You see this area where you see this line,
Mm.
that's probably where I would place my entry. My stop loss will be here. Okay. Yes. Now, my TP would have been here logically because I was expecting it to come inside this FVG. Now, but I would trail the stop. So if I get like 1 is to 2 or 1 is to 3, I might decide to close half of the position and then move my stop loss to break even. You know what break even is?
No, I've been hearing it, but I don't know what it is.
Okay, break even is simple. Now, break even means when you take your stop loss, you know your stop loss is where you don't want markets, how far you want markets to drain your money.
Yes.
So just take your you take your you move your stop loss and then put it inside the profit zone or you put it to your entry.
Okay.
What will now happen is if market goes back, it will just hit that your 3 points and
Which
it will close. So
which means the initial profit you have, you can no longer be at disadvantage no matter what happens to the market.
Yes, what will happen is you would not get the profit again,
Okay, but
except you have taken cash out. You understand? But
okay,
the guarantee is that you don't get any loss because your stop loss have moved from that place to your entry position. So that's why it's called break even. So you're not getting any profit, you're not getting any loss.
okay, that's fine. So that thing you said I should write. You said the smart money correlation (SMC), right?
Let's say SMT, right? SMT. Um,
SM
Now, for
SMT or C.
T,
Okay, smart money two.
yes, or you just say SMT divergence
Okay.
and you start.
Uh,
So so this is it. That's what I'll do if I want to take it from a higher time frame. But me, I like trades with high RR, like high risk to reward. So what I would have done is I'll be watching the market. I would watch these markets here. But once I saw this close, let me show you that close, and then you will see the confluence. So you understand that you trade by confluence. There are many things you would see that would make you take a trade, and those things are all based on logic, not intuition, not what you think or what you feel. If you trade based on what you think, bro, you will blow your account tire. Now observe, this was a bullish candle, and this candle has already traded into this place, and already had already mapped out this place. And my anticipation was that when market comes to this side, it should come down. You understand?
mm,
That was the first thing I had in mind. Now market has already traded bullish into this place, and then the next candle, this candle here now, traded again, took out the high of this candle, and then closed bearish. Normally, when we have this signature, we already know that okay, market is moving, market is changing, right? It will the next candle will come below. So this has already told me that okay, since I'm expecting the next candle to trade below, and I'm expecting market to move from here below, come down more, based on what I've seen from the daily, this was where I would have taken my entry. This was where I would have scouted for. So this is what I would do. Let me show you. So I would mark out this place here. I can mark it as TS. I like using TS. Many people call it different things also, but they're all the same concepts. So I would mark out this place. Then let's say TS photo soup. Now I showed you. Have I showed you that stuff about time frame pairing?
yes, 1 week 4 hours, 1 day 1 hour. Traffic alignment, right?
Yes, thank you.
Oh.
So 1 hour pairs with which time frame? Which lower time frame?
What,
5 minutes.
5 minutes? Yes.
You understand?
Yeah, 5 minutes. Weekly 4 hours, 15 minutes.
Yes,
The
correct. Then daily one
daily
hour,
one
five
hour, five
minutes.
minutes. Yeah.
Yes. So this is the 1 hour. 1 hour pairs with the 5 minutes. So this is 1 hour. I'm going for 5 minutes. So let's go to the 5 minutes. Now 5 minutes is where we see a structure. Remember, for here now, although this is a structure for the daily, the structure where you see structure for the hourly is the 5 minutes. So for here now we're considering candles. I'm no longer considering this, I'm considering candles. So based on the what I said, let me do a recap again so you understand. The day I was expecting a bearish move, but I was expecting market to trade 50 more than 50% of this area, this box. So inside this box, I'll be watching the candles and see what the candles do and see if I will get any info. Now, that's if I want to take it from a lower time frame. Now, when once market traded into this place and then closed like this, I see that okay, this is a sign of change in direction. So instead of going to take this high, it is now coming to take this low, and it is inside this 50%. So I'm not just expecting it to just come to this fair value gap. I'm expecting it. So okay, there was no fair value gap here. So I was expecting it to trade lower to take out all these lows and then reach for that higher time frame FVG, which is this place here. Okay. Now, this is how I'll frame the entry. Let's start with the 15 sorry, the 5 minutes. Aperture allows us to see that area. I'm wasting network not even flop today. Sef. Okay. Okay. I'm with you. See with you. I'm just waiting for this thing to move. This is the points that we're looking at. And this is the 5 minutes. The network is poor, so things are not loading as fast as they should. So this is manageable. Okay. So now check out what happened here in the 5 minutes. This was the box I told you I was looking for. I was expecting markets to go to. Now, how would I have traded this? It is simple. Now look at what happened here. This this guy was trending up, going up, going up. This was the last bearish candle. Now after this bearish candle, market went up and then slammed down with a very serious bearish move. That was first. Now after I did that, it retraced again. Normally, if it is to continue that bullish movement, we would expect it to take out this high here, but it did not take out the high. It is rather it came out and took out this low that it created. When a market is supposed to take out a high and does not take it out, that swing is called a failure swing. This is a failure swing. So it did not take out the high, but it came back and took out the low. So that was already telling me that okay, market has changed structure. Now when it took out this low, when it closed, because this candle closed below this low here, as you can see. Now when it did that, there was a fair value gap that was created. So my anticipation would be markets to trade into this fair value gap and then trade downwards to take out this low and then ultimately reach for that higher time frame this thing. Now, this is how I would now frame the trade. This is where I will now take my entry from the 5 minutes here. This fair value gap. I can decide to start it from this side, but I like taking 50% of the fair value gap. So probably from here. And my stop loss ideally will be on this other side. Now you can put this side, you can put this side, anywhere your mind carry you. But here is fine and here is better. You get.
Mm.
So let's keep it here, and then let me show you the target. Let's go for the targets. This is already giving us almost 1:2. So this side is 1:5 or close to 1:6. Now this is that point. This is that higher time frame FVG that I was expecting. Now, so from these 5 minutes, if we extend it to this place, this is 1:10.
Mm.
It's 10.17. So 1:10.17. But it did not give full 1:10.17 because it did not enter into that side. But if you check the lowest place that it reached for, if you check the lowest place is reached for, you see that we got nothing less than 1:8. Okay, close to 1:9. Okay, we can just say 1:8.7. That's one is roughly 1:9. So if you had held this trade and then you don't get 1:5 already because 1:5 was on a clean spot, this place here was on a clean spot. That was already a good risk to reward. So when you see all those big risk to reward trades I place, this is a logic. This is a logic I use in framing them, and that's the idea behind them. You understand?
Yeah.
Okay, so everything is well,
Yes. I'll just go back and watch. I'm recording it from here.
back to the so this is the idea I have. Now now I said we're discussing PD
RAs,
arrays today,
previous
right?
base range area, right?
And we've touched on it somehow. Now PD arrays are called price delivery array. Price delivery array. Let's go back to the one diagram for you. Okay. It's still loading. Also, PDR is price delivery array. You can write it down if you want to. And those price
Wait,
delivery
wait, sir,
arrays
wait.
are
The
like
the array, is it ARRAY?
yeah,
Okay.
PDR arrays, and it is price delivery array. That's what it means. So price delivery arrays are they are like points that markets. They are like levels. We can call them key levels that markets reacts from. Points where market reacts from, or points where market targets. Now, these places hold liquidity. These places serves as support and they serve as resistance also to market movements. So they are like parameters. They are like they are zones, key zones that the market makes key movements. So they are the places that determine where the market turns, where the market stops, where the market retraces from, where the market makes another move. Okay, I just said price delivery arrays. Yeah, it's called price delivery arrays also. But then also writes um, premium and discount arrays. That's another word for it. Premium and discount arrays. And use premium and discount arrays instead. That would be easy for us. I would explain why. Now, this chart has already given us one premium and discount arrays. Now, how do you mark a premium and discount? Firstly, you need to understand the idea of a range. Are you with me? Just say yes, man.
Yeah, yeah. I'm with you.
Okay. So if you get a range that you're working with, now we'll go over to the monthly. Remember, I told you that each candle is a range, right?
Yes.
Mhm. And markets either trades out of a range or consolidates in the range. That's just the two things. It either trades out to go below that range or trades out to go above that range, that above that candle. That's the idea. This one from here to here, that's a range. Market retreats into it and then closed with this one. And then broke out of the range. The next candle, which was this one, also did the same thing. It traded out of the range, but then snapped back again and then traded and then took out the so it did the job. Okay.
I'm not hearing one thing you said. Oh, network.
Yeah. Now, this next one traded out of the range and then closed back inside the range. Now, this is the range we were working with, and we are expecting it to be bullish, right? Now, so what you will do ideally, like I think so I see that way, and then definitely can you hear me now?
I can hear you, but I wasn't hearing you. Network are preventing me from hearing you before. I'm hearing
Obi,
you
can
now.
you hear me now?
I can hear you, but network was the problem before, but I can hear you now.
It's okay, let me hear you since I don't hear you now finish.
You are hearing me now? Hello, can you hear me? Hello? Hello, can you hear me?
Okay, okay, okay. So what happened was I heard yeah, yeah, I can hear you. I can hear you, Obi.
Yeah, you can continue now.